Hey everyone, my name is Lindsay Hampson and I'm the owner of ThisRock. So, the question of the week is, how do banks and financial institutions use sustainability and ESG, or environmental social governance? So, if you have a couple minutes, I want to tell you. Well, I'm sure you know what a bank is and what a financial institution is, but maybe you don't know what sustainability and ESG is yet. So let me cover that really quick. Number one, ESG is environmental social governance. Basically, it looks at a company or organization through three lenses: one, environmental impact; two, social impact; and three, governance. And sustainability is making sure that an organization is thriving today, but not at the expense of future generations being able to thrive. Whenever we hear ESG and sustainability and a bank's name or a financial institution's name, typically, I'm being completely honest, it's usually negative. It's usually in the news and it's about a bank maybe greenwashing or something. But there's a growing importance of ESG in finance and in banks, and I'm going to talk about them right now very quickly. The first is we're definitely seeing that investors are prioritizing ESG along with other indicators of financial performance. So, an example in the US is the SEC, and in the UK, mandatory climate related disclosures are coming into effect. And really, they're pushing for transparency and sustainability. Here in Ontario, Ontario's FSRA and OFSFE are driving integration of ESG through their reporting standards as well. And so, in one case, they're using the Task Force on Climate Related Financial Disclosure for any financial institution in Ontario. Customers are also increasingly favoring brands, aka banks, that care about sustainability. If you have money and you want to put it somewhere, well, you have options. And so maybe, somebody would choose to work with a financial institution that has a sustainability plan, for example. And then finally, governments and regulatory bodies in Canada, the US, the UK, and all over the world are starting to mandate these ESG disclosures. And if it hasn't been mandated yet, it's starting to be recommended or suggested or under public review, for example. But honestly, it's growing in importance for sure. So, if ever you're bored, which maybe you'll never be, but if you ever have a couple minutes, go to your financial institution or your bank's website and go to their sustainability or ESG page and read. And maybe it's there and it's robust, and maybe it's missing. So, it's interesting. How are banks incorporating ESG into their operations today? Well, number one is they're integrating ESG into lending for sustainable projects. So if they have 5 projects to pick from, well, maybe they're more favoring or looking at ones that involve sustainability in some way. Again, what is sustainability? Well, it could be environmental impact. Maybe it's putting solar panels on a roof, or maybe it's making sure that water usage is the most efficient it can be for a company. These are just examples. 2 is ESG criteria guide for investment strategies. So again, kind of similar to the projects, but if they're investing in something, is it sustainable? Does it make sense for the bank to put its name against this? The third is climate risks are included in risk management. So banks have always been risk adverse. They're always looking at and calculating risk. But now they're adding in climate change risk. And what does this look like? Well, we've seen it all in the last couple years, right? We've seen rain bombs. We've seen smoke canceling flights from forest fires thousands of miles away. We've seen extreme drought. We've seen it all, right? So we would look at those physical risks of climate change and then help kind of change up the strategy, for example. Banks are now offering financial green products, which you've probably seen in ESG investing, for example. Climate engagement on ESG issues is promoted. And the last one is ESG metrics in decision making. So if a bank was going to make a decision, typically they would go to traditional ways to make a decision, looking at the bottom line, looking at risk. Now they're looking at some ESG factors as well. So this could be reputational risks, physical risks. There's so many different types of risks that could impact the bottom line and impact decision making. So, a couple no-brainer reasons why banks and financial institutions would do this. One is it improves their risk management and resilience. Two is it would attract the ESG sustainability conscious investor and client. Long term, it would help profitability and sustainability and stability. It would boost reputation and trust, which every bank wants. It encourages innovation in sustainable finance, which is this whole new topic that really is catching on. And finally, it would align with regulatory requirements as they are slowly but surely rolling out. So there are definitely some case studies, and I want to highlight just a few right now. The first is from up here in Canada, the Bank of Montreal, or BMO, we call it, integrated ESG factors into its operations, leading to enhanced profitability. You can go read about it on their website, and also an enhanced reputation in sustainable finance. So it's tough to earn that because you can say whatever you want on your website, but if you're really enacting it, it builds trust. Outperformance of sustainable investments. BlackRock is such a good example. It's in the US. You probably hear the word sustainability, and some of you immediately think of BlackRock. It has seen sustainable investment funds outperform traditional funds. Again, they're not for everybody, but BlackRock has really paved the way. Major funds funded by green bonds. The Toronto Dominion, or TD Bank, issued green bonds to finance renewable energy projects. And this was an example of demonstrating successful commitment to sustainability in the form of green bonds. There's other ones: reduce losses via climate risk management, which is what I talked about, rain bombs, supply chain disruption, for example. JP Morgan Chase in the US implemented robust climate risk management practices, which have helped mitigate potential financial losses from the environmental risks out there. So you can think of an insurance company always looking to see what's coming up next, what could potentially happen, what are the risks. Well, banks are doing that too, which is extremely smart. While I definitely can't predict the future, I can tell you a couple of trends that I'm seeing as a sustainability consultant here in North America. Number one is definitely stricter ESG regulations. So, in many circumstances, there's no regulations or it's voluntary, but I am seeing it flow through banks and financial institutions almost first. And so, if it's voluntary today, it's definitely going to become mandatory in the future. Number two is growth in green finance products. And again, I've mentioned this before, but it's not for everybody, but it's going to be for more people, bigger percentage of the pie as we go. Number three is data-driven ESG risk assessments. So based on data, what are the physical risks, the regulatory risks that will impact banks and financial institutions? That's going to be looked at. Data has always been important, but data is going to be extremely important in this case. There's going to be lots of reporting, and we need to see it transparently. So, for example, if a financial institution doesn't quite know the answer to an ESG-related question, they should say so. We shouldn't do any lying. We shouldn't do any greenwashing. A bank should just present itself, baseline, warts and all. This is where we are. This is where we want to go. And then good faith initiatives in order to reach targets. That's the future. Three is focusing on climate action strategies. Again, this wonderful, beautiful generation that's coming into the workforce are taking over management roles. They deeply care, a big portion of them, about sustainability. And so we're definitely seeing a focus on climate action, even in banks. And financially, increase global collaboration on ESG standards. We kind of saw this for accounting many, many years ago. There was a bunch of different ways to do accounting for a business or organization. And then slowly but surely, we came down to a few different ways to do it, or standards. We're seeing that in ESG as well. There's a few big ones out there. We're definitely seeing it funnel into the ISSB, or the International Sustainability Standards Board, who will likely determine what the winner is. But it's a bit of an alphabet soup right now. If you ever have any questions, I'm happy to answer them about any of the standards or regulations or frameworks out there. Well, thanks for sticking around and watching to the end. I appreciate it. I hope this was helpful to you, maybe to your organization, or as you pick a bank or stay with a bank, or you figure this out for your financial institution. If you ever have any questions, you can leave a comment below, or you can message me anytime. I'm happy to get back to you. And at any point, if you want to have a 15-minute call, please go to ThisRockESG.com and you can book a 15-minute free consultation. All right. Thanks again for watching, and have a great week. See ya.